Let's start. Let's quickly do a new chapter, derivatives. Let's shift to a new chapter, derivatives. Derivatives, I'll quickly do a briefing of how the market looks like. When we speak about the market, there are two types of market. One is called cash market, in which you do actual buying and selling. I'm on slide number 1. Second is called derivative, FNO. In our course, what we have is this FNO, futures and options. Futures and option is something what we have, although we'll be using a lot of cash market also for some strategies. In the cash market, what we have, what you see in the demat account, actual buying of a share and selling of a share. You buy, the NSE is in between. When the two people trade amongst each other, they do not know with whom they're trading. We call them as the exchange traded contracts. And in cash market, you buy, make the payment, you sell, receive the payment. Derivative is FNO, futures and option. These are called cash settled. Although there is nowadays we have a delivery system also. Your exam maybe once long time back, 2010, there could have been a question asked. Present scenario, we have a delivery system also, but you imagine that nothing will happen. It's only settlement of a cash. Anyone who wins will take away the cash, who loses will give the cash. That's it. So profit and loss would be adjusted accordingly. I'll start with the option market. Futures and option. What we have, option market is nothing but, if I look at the first prima facie reading of the option, it's a right to buy or sell specified asset, specified price on or before due date. Specified price, that means you can do betting on anything. For example, let's suppose you do not have something in hand and you think the price will fall down. Generally we cannot sell. FNO allows you. So in a futures and option market, that allows you to sell it off. Now before I go, I'll just quickly show you 2 minutes so that you get a clarity in the cash and the FNO market, because I don't want if questions should confuse you, because there would be some problem of the time value of money and rates. I'll not be able to spend a ample enough time, but briefly you should be able to bifurcate between markets. For example, when I speak about, let's suppose this is a stock market as a whole. When we open up first screen, we get hit something called equity. This equity, when you see here 14.25, this is a cash market price. Cash market means anyone can buy, anyone can sell at this rate, assuming this is the price, buyer, seller standing at same price, and you can buy and sell. So the trading can be done on 1 share, 2 share, 3 shares and so on. This is called cash market, which you generally have in your demat account. FNO is not given to everyone. Nowadays we have started seeing FNO a lot. If I click on the second part called derivatives, this kind of a chain opens up. Now what I was talking to you was equity, and this was cash market. Then I opened up derivative. 14.25 was the cash market rate. Derivatives I opened. In this we have, the derivatives will have two types again. This one is the, you can have stock futures. If I look at, there is a stock futures and option contract. Let's suppose I click on stock futures. This will open up only 3 months. Practically only 3 months trading can be done. Since we are in the month of March, whether we do today, tomorrow, etc., till 28th March, we'll have only 3 contracts. The moment 29th March comes, for example, it's a holiday, I think 29, whatever comes after 28th, then they'll have a next 3 months. And if you look at the futures, for example, if I look at this part here, the price which closed was 14.40. So there's a difference in the cash market and a future market rate. Maybe this chapter it will help or not, but in the currency derivative certainly will have something related to cash and the futures market. Why the difference comes, we'll learn in this chapter only. There is a slight difference because of what is the meaning of this 14.40, sir? Understand the meaning of this 14.40. If I say it's a last close, it means you can do the agreement today, of settlement happening on, it's like a forward contract. Forward was over the counter, this is via stock exchange. So anything via stock exchange is future, otherwise it's as good as a forward. You can do the agreement today. Settlement will take place on the last Thursday of the month, that's 28th March, and rate is 14.40. Difference between this rate and the rate of the cash market is because of time value of money. So we'll learn that time value of money, what comes out as the timing will go down, will start coming to nearby. Then second type of market comes is option market. That's slightly more cumbersome, which comes. There are n number of options. For example, it could be call put. In the call, we can have a different strike prices. Futures will not trouble you so much. The options will have different strike prices, 16, 18, 15, what rate you want to bet at. Then different prices will have accordingly. March option you have, April option you have. So there are n number of options, n number of prices, and betting are done on accordingly. That's the option market is slightly cumbersome in that. For example, if I open up the stock option, I can open up the expiry 28th March, it will open up, and I can open up only call options, only the call options. These are all the call options. They are in red because the price has fallen today. If I would have put the put, it would have been the plus sign which comes out. Sir, will all shares have the derivative? No. For example, if I pick up here, let's suppose Yes Bank. This used to be, I think, part of Nifty at some point of a time, but not even a part of derivatives now. This is not part of this is only equity. So every share is not part of derivatives. There are around 4,000 odd script, maybe 150 to 175 scripts are part of derivatives. Practical orientation. Only thing to remember is there is difference between a cash market price, future market, and why the rate comes in, why we have different type of market, that we'll learn. So what our course tells us is prima facie about this. Objective of this is standing today, doing an agreement in such a way so that you are safeguarded. That should be the actual objective of derivatives, which has been defeated in the last 3 years 100%. Because we, from the exam perspective, we have only one expiry last Thursday of the month. In India nowadays, every day there is one expiry. Someday bank expiry happens, some Nifty expiry happens, weekly happens, Thursday happens, Monday happens. So it has become a betting market. If you ask me the correct words, if I should use for the sake of understanding, this is should have been a hedging market, but this is betting. And in betting, there is only one possibility: anyone who wins, anyone who loses will give the money. It's a gambling. I should be using a word, but that's not a nice word to use. But that should be the word. India perspective, if I say, and people are losing money heavily, you cannot even imagine the kind of money they are losing. Just for your knowledge purpose, I'm sharing. And regulators have to take a call. We cannot do anything on that. But anyhow, when we come to the options now, option is a right. In simple words, if I say, for example, you would fill up your examination form, you have the right. If you will want to give the exam, you can give the exam. If you do not want to give, institute cannot force you. That's called option. Option is right. Paid a small token money, that's called fees, and then you have reserved the right to appear for the exam. And if you appear for the exam, they'll give you the place and paper to give the exam. That's called option. Two type of rights I can have. In fact, two type of betting can be done. Betting can be either price going up or price going down. Now it depends on you. And second important part is betting can only be done when second party has a opposite opinion of yours. That is how the betting can be done. Otherwise, betting cannot be done. So for example, you expect price to go up, I expect price to go down, we can do the betting. Option is one kind of a contract. It's right to buy or sell specified asset, specified price on or before due date. And then I have taken in some points, just read out for a single minute, right? Just with you, and 1 minute. Option is the right to buy or sell specified asset, specified price on or before due date. In India, we have on due date, that's the last Thursday of the month, which happens before due date. American option questions in your exam come on the American options. Now, for example, I'll just take a rough data. Let's suppose idea is trading at, idea is approximately, I'm imagining, at 14. Now two opinions you can have, either the price will go up or go down. Any kind of betting you can done. When you do a naked betting, that means going up you win, going down I lose, we call it as a futures. That's it. When you want to pay a small token money and you want to be protected against the opposite direction, for example, you expect price to become 16 rupees by the end of the March. 14 rupees call option premium, I think today would have been trading approximately at 14.90 paisa. It's a huge premium. In fact, I say give me 90 paisa, take the right from me, you can come at the end of the expiry and buy from me at 14 rupees, no matter what the price becomes. If the price becomes 13, 12, 11, the option would lapse. The option would lapse. So we'll divide our option into two sides for the exam purpose so that things become easier. It's upside betting or downside. That means price going up, upside, price going down. Call is upside. In fact, entire chapter I should be telling you in the option, remember two terms, no matter how complex the strategy comes in the exam: call and put. The problem occurs in the chapter is you start reading something called writer, call holder, put writer. Nothing has to be written. Just remember two terms: call is price going up, put is price going down. Rest things I'll revolve around, don't worry. Just remember, call is exercised or call gives some money when the price goes up. Now if the buyer of the call is there, he'll have a profit. If there is seller of a call, he'll have a loss. When we'll do the practicals, I'll tell you. Remember only call and put two terms. Call is called upside, put is called downside. Call when price goes up, put when price goes down. Do not think about the writer in the entire chapter. Let me become a writer, so you're a holder. Do not think why I do it. In the meantime, when we are doing, I'm summarizing, I'll tell you why writer becomes a writer and so on. When we say option, we call it as it's a right to buy. Right to buy is a call option. Right to sell is a put option. The rate at which the betting is done is known as a strike price. On due date, European options; before due date, American options. The person who buys the right is known as a holder or buyer of the option. He pays the option premium. His maximum loss is option premium. He'll not lose more than it. The option premium. The person who sells the right is known as writer or seller of the option. He receives the option premium. His maximum gain is the option premium. Writer. When doing a question, you will realize that option holder is the person who makes a lot of money. But in practical life, there is a writer who makes some money. Anyhow, a simple person cannot become writer. Don't worry and do not even become it. Margins are huge. And if there is one bad month, then a 1 rupee thing. For example, I was telling you a week back exactly, not even week, 5 days back, a 10 paisa became 1.5. So if writer was there, he would have earned only 8,000 and paid more than 1,20,000 on the idea. This is about the writer. Option is a right to buy. Either you can buy the right of upside or you can buy the right of a downside. Just two terms to remember. I think one more slide I would have taken. Yes, I have taken one more slide. That is important. Only thing has to remember. Do not read or remember holder, writer as of now. Do not remember as of now anything. Just remember call and put. Call is price increasing, put is price decreasing. Right to buy specified asset, specified price on or before due date. This 99% does not give problem to anyone. Why does call option is taken? Price is expected to rise. Option would be exercised when market price is greater than strike price. Option would lapse when market price is less than strike price. Let me see if I've taken the example here. Exercise price was 1100. Actual market price on expiry either becomes 1300 or 800. If the price falls, option would lapse. If the price goes, gain to the holder, loss to the writer equal to 100 rupees. Premium I have ignored here. That's call option. Call is you have taken the right to buy at 1100. If the price becomes 1300, price increasing basically is exercise, decreasing is lapse. Similarly is a put option. Put is the right to sell. Right is only with the holder, the person who pays the premium. Right is with you because you have paid the fees for the examination. Institute has no right. They have the obligation. If you go, they'll have to provide you the seat to write the exam. Specified price on or before due date. expectation is price decrease. Option would be exercised when actual market price is less than strike price. Option would lapse when AMP is greater than strike price. Example I have taken same. Let's suppose you have taken the right to sell at 1100. This would be exercised when price falls. If it becomes 800, it would be exercised, gain to the holder, loss to the writer, and if it increases, option would lapse. Different combination will make as we move forward. As of now, only two terms. Call if it comes, upside, put is come, downside, that's it. Holder writer, how to write the answer in exam, that I'll tell you. No need to worry on that front. I'll try to make some combination, although level of your exam has been very, very simple, particular to this chapter with respect to options in the normal questions. Just read this slide once, then I'll move to the next slide. Then I'll move to the next slide. If anyone remembers anything from this chapter, forget at least that. Three terms to be remembered only entire chapter. Rest I'll make combinations. Call, put, and futures. Futures will not trouble at all. Futures will give you problem only when combination comes, and your mind should be very alert that we are in the FNO market. We are not in the normal cash market as of now. Now next slide, I have given you a chart like this. I have given you'll have this kind of a chart. The differences, you might have a black and white, I have colored difference. Now look up this part please. Now when we have parties to the option, when we talk about, there are two parties, holder, writer. Holder is the person who will pay the premium. Now when I am making this structure, the call holder should be read. E plus we write with the call holder, E minus with the call writer. E would be read along with this. Would be read along with this. A right to buy, this person will have obligation to sell. Pays option premium, he receives option premium. Maximum loss is premium paid, his maximum gain is premium. Do not worry sir, why he will take such a liability and receive only premium. 99% he will only win, don't worry. Practical life, unless until some extreme event happens like what happened last week. If idea for example is today 14, entire month if it goes to 15, 13, 15, 13, 14, 14 and a half, 13 and a half and remains at 14, writer will eat away the premium. Only exception is if the price moves unexpectedly up and down. So in out of 12 months could be a possibility 11 months writer ends up making a money. There could be very, very high chance. The holder only pays a premium, keeps paying token money and token money goes. Maximum gain is unlimited, maximum loss is unlimited. Profit when price increases, his profit when price, loss when price increases. Expectation price increase, expectation price decrease. We call him as a bullish, bearish. Call writer is a bearish. Remember from here, there could be possibility I might make some strategy. I don't know I have taken it or not. Call writer is a bearish, call holder is a bullish. You have to read the definitions and the questions from his point of view. That's his point of view. How to appear practical question, that will come back. Now when I am reading a put option, put has to be written with the writer case again. Put is a right to sell, is obligation to buy, pays premium, receives premium, maximum loss premium paid, maximum gain premium received. Maximum gain I have written here strike price. Reason being, although it will never happen, the price will become 0. For example, put will give me profit when the price falls. If idea is 14, the maximum it can fall is 0. That means I can have a 14 rupees of a profit. So I have written it as strike price. Some books write it unlimited because it cannot happen that anyhow derivative stock cannot become 0. Idea is only one of these stocks. In such a category, it is part of FNO. Otherwise, idea should not be part of FNO. Because it's loved by the public, loved by everyone, so it is part of FNO. Otherwise, The shares like idea are not part of the FNO. FNO means they are very stringent regulatory requirements for them, and the highest quality of the shares amongst all, which have lot of volume, etc., depending on different criteria. So idea is an exception which is there. It can fall maximum is what? 14 rupees. You can have maximum loss is strike price, profit when price decreases, profit when loss when price decreases, expectation price decrease, expectation price will increase. This is bearish and this is bullish. Now if you look at this chart here, call holder is a bullish and put writer is also bullish. There is a huge difference between both of them. There is a difference between them. Some students might turn up, sir, he is also bearish, he is also bearish. Then why does he take unlimited loss and becomes a bearish, the call writer, whereas he can have limited loss and become bearish? There is a difference between the holder and writer. Philosophically, difference between them is holder nomenclature is, for example, if exercise price is 100, this type of a question has not appeared in the exam. I am expecting examiner to set a question on. I think I have taken one question on that. Exercise price is 100. You have paid the premium. I am not taking any what premium you paid. You are a holder and you have taken a call option. That means you have taken right to buy at 100 rupees. I give you few choices. What would you love? Plus minus of 1 rupee, plus minus of 5 rupees, plus minus of 20 rupees. You are a holder, call holder, C plus. That means you will win when the price goes up. You will be winning when the price goes up. So I'm not even taken the premium, etc. I'm asking you three choices I gave you. Plus minus of 1 is good for you, plus minus 5, plus minus 2. Any opinion can come. I want, because that is something which will tell you why writer becomes writer, holder becomes plus minus. It has to be plus minus 20. For example, holder, if either it becomes 99 or 101, or it becomes 95 or 105, or it becomes what? 80, 120. If the price falls, option would lapse. Whether it falls by 1 rupee, 5 rupees or 20 rupees, option would lapse in all the cases. When the price increases, I am saying whatever has to happen, happen with the force. Whatever has to happen, happen with the force. If you go up and down by 1, I will be winning only 1. If you go up and down by 20, I am in profit of 20. Loss in all circumstances is what? Same. I hope you are getting my point. The nomenclature of holder is volatility. He is volatile in nature. He loves volatility, fluctuation. Whereas writer will do what? Writer say fluctuation should come, but it should not come with a huge volatility. A minimum of the movement should come. So he will prefer plus minus 1, writer. Writer is non-volatile in nature. Holder is a volatile in nature, and accordingly graphs also made the same way. So volatility is loved by the holder. He says if you move one at plus minus 1 or plus minus 5 or plus minus 20, lower side I have always option what? Lapse. So if you have to move with 20. That is exactly what he is asking for. Whereas writer says if you have to move with least fluctuation, and that is a difference between both of them. He is actually a volatile bearish. He is non-volatile. Writer does not expect lot of fluctuation in the market. Holder expects a lot of fluctuation. Accordingly, the strategies are made. I'll come back to it. Don't worry. In fact, let me discuss some strategy. Then we'll move to the question way of doing it. Since I have the second chart on the next page. Do you have this chart? No. Not there? Okay. Anyhow, you can see from my. I'll just show you what I said, volatility. So what I was telling you in the volatility and non-volatility, what? Some major questions which come in the exam without any kind of a direct wording are on a straddle strategies. Straddle is basically same strike price you have. Straddle is basically a same strike price strategy you have. This is not there. You can just look at this. I'll see the question. Don't worry. Long is call and put holder. When I expect, for example, elections, or when the idea board meeting was there, ideally someone who should have taken C plus P plus both. Whether no matter what side movement comes, he wins both side. He's buy both call and put, same strike price, maturity period same. Expectation market would be volatile. If you look at this chart graphical presentation, this is graphical presentation. This is actually a break-even points. This is a maximum loss, and he would be making volatile. Volatile means this is this way. That means as the market opens up, whether upside downside, making a profit, we call it as a volatile. These are the holder philosophy. Writer is a non-volatile. He expects market to remain in a range. If the market remains in a range, he will end up making a profit. If the market becomes volatile, he'll keep having what? Loss. So that's the volatility nature which comes. When we make this kind of a graph presentation, when we say this is the graphical presentation, for example, it's V-shaped is because single strike price it we have, it will take a single curve. The number of strike prices we have, graphs takes according to those curves. So not required for the exam purpose, just for reference purpose. These are break-even points. Now in this case, this is called volatility. This is a holders. Writer is basically he will make profit in this scenario, loss non-volatile in nature. That's the nature it becomes. Similarly, strangle is the strategy. I think first example we'll cover on strangle only. You have two strike prices, so graph will take two curves. Actually, this graph is a composition of, this is a holders graph and this is a put holders graph. When you combine both of them, this becomes this kind of a graph. So there are two curves, two strike prices are coming, and in this case we call it as he will make a money whether the price goes up or goes down. That's called volatile in nature. And writer will be non-volatile, different strike prices. So why he takes same and different strike prices? Because the premium cost differs. If I take a same strike price, premium cost will be different. If I take a different strike prices, premium costing would be different. So some people have a habit of making these strategies based on the same strike prices and based on the different strike price. Basic purpose is call and put only. While solving a question, now you can see some strategies here. There could be possibility when you go back home, there could be some more strategy you see. No matter what you see, ultimately it will revolve around only two things. One is call and second is put. That's it. Now if I say call C plus P plus, you solve call first, then solve put second part, and then net answer comes. If it's a writer case, writer also I'll not solve from the writer's point of view. I'll solve as if it is call and put, and then since it's a writer, I'll put negative balances wherever is possibility. For example, if holder would be a positive, writer would be a negative, which we'll see in the practical. So basic nature is volatile and non-volatile, and that is how the strategy depends on it. A put holder is ready to give the premium and he wants the enjoyment of the fluctuation. The writer said there would be less fluctuations and I am happy receiving the premium. That's the basic difference, although both of them are bearish in nature. So we call them as holder is volatile, bullish or bearish, and writers are non-volatile. They expect range bound strategies to take place. Now coming back to the questions we have, let me read out first which has come n number of times in your exam. Question number 30. Number 30 we have XYZ established the following spread on the Delta Corp stock, purchased 3 months call option, 100 numbers. That 100 number is basically lot size or 100 numbers with a premium of 30 and exercise price of 550. The way of reading this is actually spread word is given wrongly. Don't read spread word. Spread is not this strategy. Spread is something else. Purchased a 3 month call option, 100 number. That's basically a lot size, premium of 30, exercise price 50. That means it's a C plus. This option would be exercised excluding premium, I'm saying, above 550. Purchased 3 months put option, 100 numbers with a premium of 5, exercise price of 450. It's P plus at 450. That means this option would be exercised when the price falls below 450. Different strike price we have. So this is basically strangle, and it's C plus P plus. That means he expects a volatility in the market, but he do not know which side volatility will come. For example, now the elections will take place. and when the election results are coming out, the possibility the market can fluctuate any side. Whatever market expected, if that result comes, there could be possibility upside. Market expects X party to win and that loses, and it will fall drastically. And fall, you cannot even imagine the way it will fall. We'll have a put option. People generally buy, call and put during this time, but writers are smart enough to know the premiums are increased accordingly because risk is huge. Fluctuation will be huge, so premiums would be very, very heavy during this time period. It's a call and put which comes out. The current price of Delta Corp is 500. That spot price as of now no use. XYZ profit or loss if the price of Delta stays at this part. Doing wise, this will not trouble you at all if it remains at 500. First of all, if I generally read, I have two things. One, C plus at 550, it means this will be exercised when price goes above 550. P plus at 450, this will be exercised when price below. If I logically try to read this out, first option both will lapse. Second option 350. Put option. Call will lapse, put will be exercised. I'll have a gross profit of 100. I'm not putting numbers I'll calculate at the end. Premium I've ignored for the time being. I'll get from the put 100 rupees. Rises to 600. Call option would be exercised and I'll be getting a gross profit of 15. Now, since I paid premium of 30 plus 5, both the premiums will be calculated. Please, it's two strategies you have taken. So both premium will end up paying. In this case, my loss will be minus 35 into 100. In this case, it will be minus 35, and then whatever number comes, because 100 numbers we have, multiply by 100. In this 50 it's a 50 minus 35, so whatever number comes into 100, that is your answer which comes. Let me look at the answer, then I'll do some analysis in this question. That what call option 550, premium paid 30, option 450, premium paid 5, total premium 35, price stays at 500. Option call and put, both options would lapse. Premium paid 30, so your loss is all premium has lapsed. End up paying a loss 3500. Now in second case, when you have price falls to 350, only which option would be exercised? Put option. Premium you paid for both of them. Put option gives you gross profit of 100, and out of 100 you end up paying 35 as a premium. Net answer comes 6500. If the price rises to 600, if the price rises to 600, in this case your gross profit would be 50, put option would lapse, premium paid total 35, so net profit would be 15 into 100. 100 is the lot size you have, 1500 which comes out. Now in this type of a question, answer can be very easily made. I'll just do some summary of it and you can apply with, this is one of the ways of doing it. I'll do in simpler way. So just to give you a briefing of this chapter. Now if I try to make up, we call this as a strategy. So my cost of strategy, I make it here. That's rough work I'm doing so that you can relate with this any kind of a working. Total cost, how much I paid? 35. 35 sir, why? It's a 30 rupees call and 5 rupees put. And I have taken two options. One I have taken what? Call option. Second I have taken option. How do I decide, sir, what is my break even and when will be in the net profit? My exercise, the call option is upside or downside? Do not think of writer holder at all, please. Call is upside or downside? Upside. It's upside, that means my profit will be exercise price if the price goes up. Since I have to cover cost of strategy, we call it as plus cost of strategy. This will help me in giving my break even. It was 550 plus 35. So my break even comes at 585. If the price goes above 585, if the price goes above 585, I will be net profit due to call option. I will be net profit due to call option. Out of the three prices, one of the price is 600. So 600 is how much above 585? 15. My answer has to come 1500. No matter you love or do not love, that answer has to come 1500. All questions would be able to check, 100% we would be able to check. And these are very, and this is the only question which repeats itself in different forms. That's it. The rest of the strategies also will make it, don't worry. But in this case, I'm saying this at least you cannot make a mistake. 7 times questions have been asked in above 585, I'll be net profit due to call option. Now, if I talk about put option, put is downside. Put will give me benefit when it downside. Sir, for holder or writer, anywhere put generally is put is exercised downside. I have to recover my premium, so I'll say my break even would be exercise price minus cost of strategy. So my this would be, sir, what is equal to exercise price is 450 minus 35. My break even would come 415. Break even would come 415. If I graphically try to draw, actually, if when you go back home, the basic charts, what you would have done call is upside. So we call it as, this is the standard graph of a call holder. That means call will make a profit when the price goes up. Single strike price, single curve. It takes a curve from the strike price. Put option will give the profit when the price falls. The graph of the put would be this. This is basically P plus and this is C plus. These are standard graph. Since we are combining both of them together, our graphical presentation would become equal to, this becomes a graph of call holder and this equal upside and downside. The graph is taking a curve from where, sir? It will take a curve from the strike prices. 450, 550, break-even points are coming 585, 415, and I should be able to read a chart. Actually, when you move away from the CA finance and go to the higher levels, you will be not making these kind of profiles. You'll be making only chart. By looking at chart, you should be able to say whether it's a upside, downside, or what kind of a strategy you are making it. That has to be done accordingly. So in this case, when I say it's a 450, 550, 585, and 415, when we look at above 585, it will be profit, net profit due to call option between 550 and 585. Actually, call will be exercised above 550 only, but above 550 till 585, it will be only recovery of premium. That will be cost of strategy. Between 450 and 550, any price, both options would lapse. Below 415, it will be net profit due to put option. It will be net profit due to put option, and below 450 up to 415, that will be recovery of a premium. So graphically I know, and now I can check out what my prices were. First price was 500. 500 was falling between these two prices. My both options would lapse. Second price was 600. Second was 600. 600 was how much above 585? 15. My net answer should be 15 into 100. 1500. And third was 350. 350 is how much below 415? It's 65. Net profit would be 65 into 100, 6500. That has to be the answer. So this is a graphical presentation. This shows me, sir, what? This shows me at different points what should be the answer. If, sir, price was 420, let's suppose, I would be in loss of 5. If the price was, sir, 550, I would be losing entire my option premium. If the price was 585, it's a break-even point. If the price is 415, it's a break-even point. That's called cost of strategy. This graphical presentation only helps me out. By chance, when you go back home and look at some of the graphs in your notes, confident how to read those graphical presentations. The 2 points we have, basically curve comes from where, sir? If you draw logically, this is my maximum loss, let's suppose. The curve will come wherever the strike price is. If strike price was 550, it's a curve. If strike price was 450, downside curve. Now let me go to the next question what we have. Number 28. Look at question number 28 once. How to do in the exam? This is the perfect question to learn how to solve questions in the exam. Let me read out the question with you first. It says, the equity shares of VCCs quoted at 210, spot price as of now no use, after some point of a time they'll start coming of a use. Call option is available at a premium of 6 per share. 3 months put option is available at a 5 per share. So call premium and put premium both are available. A certain net payoffs of a option holder of a call and put option holder. That means you are becoming, and strike price in both cases is 220. Now first of all, should be able to read the question. You are doing C plus at what? 220. You are doing P plus at 220. The total cost you will bear is 6 plus 5. How much? 11. Now call option will give you profit when? Above 231. Basically, if I draw my chart, it's a holder writer case. Holder, volatile, non-volatile, volatile. Single strike prices, two strike prices, single. So my graphical presentation would be this. No need to copy this part as of now, please. The curve will be from where, sir? Strike price. This is 220. The upside would be 220 plus 11, 231. Downside would be 220 minus 11, 209. This will help me in knowing my answer. How to present, that's a secondary part for me. Now if I look at, sir, this means how do I read this chart? Above 231 I will be net profit due to call option. Below 209 I will be net profit due to put option. Between 209 and 220 loss would be there, but loss will be limited to the premium cost. Similarly, there will be recovery of the premium between these two parts here, and at 220 entire loss would be of 11. Sir, anything given here? Lot size? No. Look up please. If the price is 200, just see in the chart where does 200 will fall. It will be below 209. How much difference? 9. 9 would be my net profit. And please understand, this chart is after adjusting for premium. So any answer which comes will be net only. So it's a 9 rupees. If the price becomes 210, 210 is, sir, where? Somewhere here. Between 2, it's below 209. 209 and 210, how much? 1. Loss of 1. 220. 220 is here. Both options would lapse, entire loss of the premium. 230. 230 would be somewhere here. I'll have a loss of only 1. That means basically 220 to 230 call will give me 10 rupees gross profit, 11 I paid, 1 rupee loss, or simply I can say between 231 and 230 there is only 1 rupee loss which comes out. 240 is how much above here? 9. How much profit? 9 rupees profit comes. Now exam answer, this is the answer. How do you present in the exam, sir? If it was a writer holder, understand from this question, I'll be slightly slow now. Understand the way of putting in the answer. I'm saying 100% case, whether you have a bull strategy, bear strategy, spread strategy, butterfly strategy, any kind of a strategy will not face a problem. Otherwise you will face a problem. Just visualize how exactly you will be doing in exam. This was just to give you the hint of how to cross check your answer. Now I'm not cross checking answer, I'm putting from the exam perspective. In exam came, I do not remember whether it was a straddle, strangle, strip, strap, bear spread, bull spread. I do not know anything about it. So what I do is, look up please. What call option 220, premium paid 6. What put option 220, premium paid this, total premium is 11. Now look up please, how do I put? What I do in the exam is, I make this chart first, whatever you see on the, what you see as of now, you see this much part, what I put. C plus at 220, expected market price, status, gross profit. Sir, why have you put gross profit? Because holder can only have a gross profit. Then I have P plus at what? 220, status, gross profit. Initial outflow is what? Premium paid and net payoff. Now let's look at what we do. Do not read both of them simultaneously. One is call and one is put. Separately we'll read. So what we'll do is, once I have put this above chart, I'm highlighting in yellow. This once you put status, since holder can have a profit, and this I put here. Now what I put is, I put up my only this much part here. This part. The first part. Strike price, the expected market price are what? 200, 220, 210, 220, 30 and 240. Now look up please. First I look at this, look up. I look at this is 220. I'm highlighting only 220. I'm not seen even call or put. I'm just highlighting 220. I highlight 220 here. Highlighted 220. This will always be indifferent. Then second part is very important now. Look at the language I'm using. I'm looking at whether it's a call or a put option. I'm not saying a call holder, call writer, put holder, put writer, nothing. I'm seeing whether first I looked at what 220. Second part I look at whether it's a call or a put option. I see only C here. Can you see only call? Call would be exercised when price increases. Sir, for holder writer in both cases, status would be as per the call option. Understand what I'm saying? 90% students or more than 90, whosoever makes a mistake, makes mistake at this. Sir, he was a writer. Exercise, apps, choice, chapter become difficult. This is how the strategy becomes for a student. It's a call option. I said 220, I looked at 220 highlighted. Then I looked at whether it was a call or put. Only call. Irrespective of whether it's a holder or writer. Call would be exercised when price goes up. Sir, for holder writer, I did not use a word at all. Exercise when price goes up. That means 230 exercise, 240 exercise, 200 laps, this laps. Now last part I check is it a holder or a writer? If it's a holder, I'll put profit in his books. If it was a writer, I'll put loss. Again I'm saying please, no matter which type of a combination of the options you are making, read from perspective. First highlight the strike price, then highlight the call or a put. Call is upside, I said upside exercise. Then third part I see is it's a holder writer. If it's a holder, I am putting profit in his book. That is difference of 230 and 220, 240 and 220. Sir, if it was writer, I'll put the loss. Then the question might come sometime in the general class. Sir, why would the status would be exercised in the case of writer? Writer do not have a choice. Call is a call option. Call option would always be exercised when price goes up. Call option would be exercised in favor of the holder against the writer. We are not checking the profit loss. I am checking the exercisability. Call option would be exercised always when the price goes up. If it's a holder, put the profit in his books. If it was writer, put a loss. Then second I see is the 220 again. 220. I highlight 220 again. At 220 it would be indifferent. Then I see it's a put or call, not a holder writer, only P or C, it's a put. Put option would be exercised. Price falls. Exercise, exercise, lapse, lapse. Then third I check it's holder writer. If it's a holder, in holder it will be a profit. In holder it will be a profit, and if writer was there it would be a loss. General mistake would be at this level only, a status level, exercise or not. Exercisability is only call and put. No matter now you make C plus C minus, you make P plus P minus, because spread strategy are based on that. It's only look at put and call. Just see the status. Status just write exercisable lapse. Then see it's a holder writer. If it's a holder, write down gross profit in their books. GP is nothing but gross profit. Writer is a profit. If there was a holder is a profit. If there was a writer, I would put as a loss. And then what I do is initial premium I know I paid what 11, no matter what was the case. Then I check out 0 profit, 20 profit, minus 11, 9. 0 profit, 10, minus 11, minus 1. Then I have 0, 0, 11, minus 11, 10, 0, 11, minus 11 accordingly. The previous graphical presentation was just to cross check these answers. That's it. That was only to check this, and this is the presentation. Highlight strike price, then check call or put, whatever it is, status, fill it up, and then check it's a holder writer. If it's a holder, in favor. If it's a writer, against. Now after this I might make some strategies, I might take some questions. Do not look at anything else, just exactly try the same way. Just quickly go through it. If you want to draw diagrammatical presentation, that's for a reference, otherwise you can leave. The diagram only tells me these are the common questions of the exam. This was 31. Once you're done, let me know. Done? Now let me look at one question. Number 43. Question number 43. An investor who feels that one script of MSS, which is currently selling at 1252, is a spot price, as of now of no use to me, could move significantly in 3 months. The investors could create a straddle. Now I'm not able to recall straddle was the same or different strike price. Strike price is 1250, expiry 3 months. Call premium 95, put premium 37. How many strike prices available? One. It means straddle is a single strike price only, even if you are not able to recollect. Problem for me is whether it is a holder writer. Question is silent. I am an investor, I can become a writer also. How do you know? Huh? It's a volatile. I am expecting institute to increase their level now. It could move significantly. Significantly is holder. Although they said cost of strategy, but it's significant movement. Significant is only from the holder perspective. It becomes C plus at what? 1250, P plus at 1250, and total premium cost is 95 and 57. Single strike price. So V shape will come. Now, how will we do it, sir? We'll make exactly same way. Look up. What I'll do is I'll make expected. Do not look copy because I have the answer with you. Expected market price. You'll write here C plus at what? 1250. You'll make status gross profit. Similarly, P plus status gross profit and then payable. Now first you'll do is you'll highlight 1250 and 1250. Which type of option? Call. Call would be exercised when price goes up. This will be lapse. And then you look at what? Holder plus sign. Is that fine? Then you look at plus sign and accordingly you make up the. Is that fine? Now let's check the answer. Look at this. If you want, you can do one thing. You can try one from your side on your own, or you do read this. I'll give you one as a exercise from my book differently. Read this. I'll give you one. What I do is exactly same way. Thinking would not change. I first look at this 1250. I highlight this 1250 indifferent. Then I look at only C, not even a plus sign. C. Call would be exercised when the price goes up. Only two things remember, please. I am saying again, call upside, put downside. Then third you look at, it's a holder writer. If it's a holder, you put in his book what? Profit. If it's a writer, you put in his book loss. So exactly put also 1250. I highlight this 1250. It's an indifferent position. It's a put option, downside profit, upside lapse. Sir, writer would be exactly opposite. It's a double entry system. So if it was a writer, I would be putting at what? Minus. And then you have an initial outflow and then net payoff, which, and graphically if you look at, I think cost of strategy is 152. If 152, break even is 1402 and 1098. This only helps me in checking my net profits. That's it. It will help me whether my answers are on the correct side or not. Quickly look at them. Done. Now let me give you one example. Here I have taken anything. I'll give it. Let me give. On a small example. Show example. Show payoff profile with the following data. Show following data. Exercise price, put premium. call premium. Trader takes a strategy of trader takes a strategy of 2p plus. Trader takes a strategy of 2p plus c plus. Expected market prices are expected market prices are 40, 40, 46, 5. Expected market price are 40, 43, 46, 5, 50, 56. Starting I'll do with you, then I'll stop at some place. What we'll write in the exam is buy to put option. So should we write P plus? It's up to you. This is a valid term for the at least practical side, but I have a habit of writing the presentation also buys option. Bracket you can put down at it's a two put option. Is more bearish than bullish. We call it as a bearish than bullish. There are some strategies strip strap. So out of that, it's more bearish than bullish. Implies outflow of premium. How much premium he'll pay? Please. Only put 4. Then I'll write buys 1 call option. Bracket what? At rupees. How much? 3. Size outflow of buys call option 50 only. This is 50. Premium outflow is the total outflow is what? Total outflow is 7. Now let us try to make our charts presentation now. How do we do? We write payoff profile. Can I move forward? Total outflow is 7. It's called initial outflow. So I make my payoff profile. Payoff profile. We have expected market price 2 plus at rupees what? Cost of. Then I have what? P plus at rupees what? 50. And then I have initial outflow. Net payoff. Prices I took was 40. Then 40, 43, 43, 46.5. Then highlight 50, highlight 50, highlight 50 and highlight 50. In front of that I write then highlight only P, put option. Downside, upside, downside. I put here exercise, exercise, exercise. This one. Then I look at what? Holder or writer. Is holder. Holder would be profit. And since it's 2 put option, double the profit will come. So 50 becoming 40, 20. 7 will give me profit of 14. Since this was a holder, I am writing profit in his books. If it was a writer, I will put what? Loss. In this case, it is 7. 0. It will not have any negative impact. Then again, I look at this 50. I highlight my 50 indifferent. Then I look at call or a, it's a call option. Call option is upside. So downside lapse, the exercise. Then you look at holder or writer. It's a holder. The holder's case. See what? Profit. Strategy is on its own. Solving is only call and put. Strategy is okay, whatever the strategy is, but it's only call and put no matter which combination of strategy he makes. I'll show you some strategy after this now. 7 rupees single, 10 rupees single. It was more bearish. This is actually part of some strategy. It was more bearish than bullish. So that's why we had this type of a combination 2 plus C plus. Initial outlay, how much he paid? 7. Profit 0, 7. Net profit 14, 0, 7. Net profit 7, 0, 0, 0, 0. Maximum loss minus 0, 7, 7. How much? He is getting more profit when downside, and he took the strategy also same. For example, I am more bearish than bullish. If I am more bearish than bullish, I take a lot of put options. But I think if something happens against my expectation, I'll cover up myself for the call option also. It was more bearish. Objective was not the bearish bullishness. Objective was how do you solve? Look at the first strike price, then put or call, and status is written from the put and call perspective, and then you write either plus or fine. Now let me look at strategy has not been touched in exam and discuss since. Trade strategy I'll discuss briefly with you so that you can make up on your derivatives. Let me discuss with you some strategies of this spread so that objective is you should be able to solve it out no matter what strategy comes. A spread strategy, in a spread strategy, a person will become a holder as well as the writer. These are limited loss and profit strategy. It could be either C plus C minus. Combinations are C plus C minus, C minus C plus, P plus P minus, and P minus P plus. Any one of them. all have different meaning, all will have a different philosophy of doing it. So there is a different philosophy of doing it. If I do C plus first and C minus second, reasoning is different. If I do C minus and C plus, reasoning becomes different for it. So let me solve it out with you. For example, I've just taken a rough number here. It's only a rough number, nothing to write here. For example, I have taken exercise price as 400. Exercise price as 400. And what I have done is, the call premiums of these are 80 rupees. 450 call premium is 50 rupees. I expect, what is the market price? Irrelevant for me. I expect price to go above 400. I expect the price to go above 400. Ideally, when I ask you when my expectation is price going up, you'll say what option to call option. I take a call option C plus, outflow premium how much? 80. But I do not expect price to go above 450. I expect price to go above 400, but I do not expect price to go above 450. So if you tell me take a C plus, sir, by paying a premium of 80, even if the price becomes 450, from 400 to 450, my gross profit would be 50, premium paid 80, I'll be in net loss. To make this unviable option into viability, we create a spread. What I do is, I do C plus at 400, I do C minus at 450, so that my premium cost reduces. What I was paying 80 at 450, my inflow would come, my net profit would be, my net costing would come down to 30. This is not an unlimited profit or loss strategy. This is called a limited profit or loss strategy. I'll show you this example fairly well so that you understand what example exactly. This example shows me that actually there are two things. If I'm extremely bullish or bearish, if I'm extremely bullish, I'll do C plus only. If I'm extremely bearish, I'll do P plus only. But when I'm moderately bullish, that means I expect the price to go above, but not above a certain point. To reduce my premium cost, I do C plus at lower price and the C minus at a higher price. Sir, what if the price exceeds above 450? It does not make a difference. I was not extremely bullish. If the price might become 500, price might become 600. So call option of a 400 will give me a profit because I'm a holder. The writer will have a loss. My profit would be in a certain range. If the price falls below 400, call option would be lapse. I'm saying call option would lapse, whether it was a writer or holder. Below 400, both option would lapse. And if I was having only as a holder, my premium was what? 80. But when I am moderately bullish and bearish, my premium cost is reduced to what? 30. So there could be this thing which can come out. I can have, similarly, I can have C minus and C plus also. The reasoning will differ, C minus, C plus. Only thing to understand is, if I do C plus at 400 and C minus at 450, there is a outflow of premium 80 minus 50, net outflow 30. There could be a case of an initial inflow also. If I do C minus and C plus, why do I do it? That is not the question as of now. There is some reasoning of it doing it. So we call them as a moderately bullish, safeguarding, moderately bearish, and so on. There could be some reasoning of the strategy. We call them as a spread strategies. There is limited profit and limited loss. There is limited profit. It is not unlimited because you are not extremely bullish or bearish. You are a limited bullish or bearish. In case of initial outflow, sir, what is the meaning of initial outflow? Initial outflow is, in this case, if you have 80 rupees as outflow and 50 rupees was inflow, net is what? 30. This is case of initial outflow. If you become C minus, C plus, that is also one of the ways of doing it. If you do this way, it's a inflow minus outflow. It's a case of initial inflow. Now we say, in case of initial outflow, maximum loss would be initial outflow. Gain would be difference of the exercise price, that is nothing but 400 and 450 minus initial outflow. So your gain would be difference of exercise price minus initial outflow. In case there is an initial inflow, maximum gain would be initial inflow and loss would be difference of exercise price minus inflow. Break-even points with the feelings or bhavna we will create. And the spread strategy what we have, I have taken majorly because if your institute moves, he'll move first into bull and bear spread. So if we have a bull spread is upside. Now if you look at this graph, what you have on the left hand side, the graphical presentation is, this is called a bullish graph. Upside you're getting a profit. When you make this kind of a structure here, it becomes limited profit. So if I remove this part from here, this becomes extremely bullish. If you make a structure here, it becomes moderately bullish. If you look at the strike prices we have, what we say, profit when price increases. The bear would be profit when price decreases. Now in exam, you can remember the rule also if you want. Simple way, a plus minus strategy is bullish. Sir, with respect to call or put, both. How can put be bullish, sir? How can put be bullish? Put writer is a bullish. Put writer is a bullish. Plus minus. Sir, what does when plus minus means? Lower strike price you do plus, higher strike price you do minus. 400 and 450. Same data I can do C plus C minus. Although only call premium I have given. If I give you put premium, I can create the put strategies also. If you do C plus C minus, it becomes a bull call spread. If I do C minus C plus minus plus minus plus, it becomes a bear strategy, call bearish. Reasoning will differ. So the way to remember in exam is simply remember plus minus is a bullish spread, minus plus is a bearish spread. The plus minus for whom, whether it's a call or put both, yes, minus plus for call or put both. Let me show you the data what we have taken just now. Let me do the data first with you. We had this data as of now. The following data I said create a bull call spread. Now in exam he gives you a 400, 450 and premium, and he says call bull call spread. Now first look at the call. Prima facie call is what? Bullish or bearish? Call is bullish, and he is also talking about bull call. You do plus at 400, minus at 450. I actually in the class I read the logics also. Logics are not required for the exam. Simply that means you've done 80 as what? The outflow, 50 as inflow. The objective of doing this is you are expecting price to go above, but you are not expecting to price to go above what? 450. That is the logic which comes out. So accordingly we make it. If I try to solve my answer in exam perspective, in exam what we'll do is my initial outflow would be how much? 80 outflow, 50 inflow. What is my premium? 30. Maximum loss will be 30 no matter what happens. My maximum gain would be difference of these two minus 30. How much? 20 no matter what happens. Logic, although I write when in exam, in the class, in exam you don't have to write. We say the trader would buy the call option C plus at 400. He expects the price to move above 400, but his expectation is price will not move above what? 450. And if he would not have done C minus at 450, his premium cost would have been 80, very heavy. If he buys only C plus at 400 and price does not move above 450, trader would be at a loss. Why loss, sir? Because he ended up paying premium what? 80, and whereas the gross profit was what only? 50. To make the above situation profitable, the moment you write C minus at 450, as his expectation is price will not move above what? 450. So analysis when we do, it's a moderately bullish. Initial outflow will reduce to what? 30, and if he was extremely bullish, then he should do only what? C plus at 400. And then I show you that what exactly what we do. 30 is my outflow, maximum gain would be 20. Since it was a bull, this is a bullish graph. The graph will take a curve from the strike prices. It's a limited, so it is called limited. So maximum profit would be 20, maximum loss would be minus 30, which, and this is my presentation which comes. I do exactly same way. I'm saying first I highlight. You can see the highlighted portions also. First I highlight 400. I highlight what? 400 indifferent. Then I look at what? C, call or put? Call. Upside, downside? Upside. Exercise. Then you look at what? Plus. In favor, against? Favor. So we write profit. Second part. Highlight what? 450. Highlight what? 450. Then highlight what? Call. Call. Upside, downside? Upside. Exercise. Then you look at writer, holder. Writer in his books are write minus 50. Understand the way of doing, please. The way of doing is first look at the strike price, then you look at call or put, and then look at holder writer. Now this was a strategy. If I give you this payoff, it does not make a difference it was a strategy or not, or it was a straightforward case. Second example, same I have taken is, for example, I'll not show you. Let's try to look at the answer. I'll take the basic exam answers from you. Create a bear put spread. When you say create a bear put is by nature is bearish or bullish? Bearish. Now let's suppose you do not remember in the exam bearish bullish. Plus minus is bullish. Minus plus is. Now I certainly cannot tell you in exam on the hand write plus minus this cheating. Openly I am saying I have never told them it's cheating on records. Cheating not to do. Plus if someone writes plus comma minus or minus comma plus, who comes to know what they have written? Cheating. So if you, for example, if you write plus comma minus, you know what it means. No one knows, but do not do. No cheating in the exam. Plus minus is what? Rest you are smart enough to know. Plus minus is what? Bullish. Minus plus is bearish. In exam you do not remember anything. Let's suppose do not remember anything. He is not asking logic at all. You do bearish. Whether it's a put or a call, bearish means minus plus. Minus at 400 and plus at what? 450. Logic is straightforward. I'll tell you, don't worry. In case exam will not ask the logic. Minus plus, that means when you do plus, you end up paying what? Premium. Here you receive what? Premium. Logic is put, you expect price to fall, but you are not expecting price to fall below what? 400. So basically, if you would have taken only P plus, what would have happened? If you take only P plus and price do not fall below 400, then you end up paying 130 as a premium. You reduce your premium. Understand the objective of it, please. This is a moderately bearish. Means you are bearish, but not extremely. You are moderately bearish. Hence, you do this kind of a strategy. So what you do is 450 plus 400 minus, so that the premium cost reduces. Now, if the price stays in range, you will be still in a profit. Your maximum loss would be 130 minus 100, and profit would be how much? Difference of strike price 450, 400 minus this. Since I have taken the same data, so plus minus will come accordingly only. This comes out. So trader will buy the put option, etc. This is only logic which comes out. Graphical presentation same way. If you look at this payoff profile, when we use payoff profile, we use it 450 your plus. I highlight 450, 450 indifferent, and then you do it. Let me actually give you one data points and then you try out, so that becomes easier for you to understand. For simple. Let me take this data. Copy down this data. We'll not do payoff profiles. What we'll do is we'll try to make a graphical presentation, net profit, losses, and so on. Example of Voltas. Voltas is a listed company. I think this could have been priced some time back. I might have taken in the class from that prices. Now I think it should be not 700. Exercise price 700, 770, put premium 36.69, call premium 75.45. I need maximum loss, maximum gain, and break-even graphs. Let me slightly discuss with you once again. Bull is price increase, call holder is bullish, even put writer is a bullish. Call holder is bullish, put writer is a bullish, put holder is a bearish, call writer is also bearish. So when you have these two first, First two cases will not trouble you. Pull, call. Pull would be plus comma minus. Pull would be what? Plus comma minus. Bear would be minus plus. Now let me again do a recap. In fact, first you do is what? You do the first two only so that you are comfortable. Third, fourth I'll discuss with you. I have not logically discussed with you. I'll discuss with you what happens. Let's suppose you take bull call. You do C plus at 75, and sir, what is the meaning of 700 770 when you gives these two strike prices? Na? The objective is expectation is price going above 700 but not moving above 770. So if you do C plus at 700, the premium outflow is what? 75. Even if the price becomes 770, still you will be in net loss. The moment you write C minus, first case, the moment you write C minus, first case I am taking, the moment you do C minus here, so you are able to reduce your premium cost. Initial outflow would be what? 75 minus 45, how much? 30. That will be a maximum loss. Net profit would be, sir, 70 minus 30, how much? 40. Bullish is upside or downside? Upside. So basic bull chart is basic bull chart. This is the basic, and since it's a limited, you will have this kind of chart. That means these curves will come from where, sir? These curves will come from strike prices, and loss will be limited to what? 30, na? 30. Profit was 40. First break even point, first graph is 700. Now how logically you think about the graph? If I am at a loss of 30 when the price is what? 700, and I'll be in profit when the price moves above. When the price moves above, so how much I have to move here? At 700 I am loss of 30. I'll be in profit when the price moves up. I need to cover 30. So what would be my break even? 730. That is called bhavna, feelings you have. The first case we have. Can I show the first answer now? The first answer. This is my first answer. Pull was plus minus. Since it was call, it was straightforward. Pain was not there. 700 outflow. So have they touched this in exam? No. But if they do not touch, that means they have not developed themselves in the derivative market. Derivative market have developed so much in the last couple of. Although these are not very common strategies what public applies, but still in a range bound market people make money. Not that easy to create a spread strategy. 99% of the public only makes is the call put or any strategy with the normal call put. Same data. Second, you have to create what? Bear put spread. Try on your own. Actually, there is a symbol when you write. There is meaning in that. For example, when you write call of plus minus, automatically you should be able to speak on the logic of it. I did plus first or minus first here? Plus first, na? So I did plus first, assuming price will go above 700, minus assuming price will not go above 770. So it became range bound. Now second, when you're doing put also, you're doing minus plus. You're doing minus plus. So put was what? Coming down, na? Actually put bearish means you would have done plus only first. Means what basically means is, look up please what I say. Actually when you make this strategy, although you write minus plus, but in this case, since it was a put strategy, put bearish means you would have first done what? Plus only. The second one plus. And then you did what? Minus. Although writing wise I am writing minus plus so that you can remember easily. But since you were put holder is bearish. Put holder is bearish, that means he would have done first P plus at 770. So then why have you written minus plus? So that you know minus it as a lower strike price plus at a higher strike price. Now sir, why are you focusing on he did plus first at 770? To explain again, he thought price will move below what? 770, and then he would have done minus, the price will not move below what? 700. So logic came out of that. Similarly, when you will do the next strategy now, I'll be able to make a logics for you that why they are doing that, the bullish put or a bearish call strategy. In this case, in exam you do minus plus. If someone says logic has to be from the plus and minus in this case. So the logic was he expected price to fall below 69 but not below what? 700. Initial outflow how much came? 30, 33. Maximum profit would be 70, 37. Now graphically don't have a problem please. It's a bull graph or a bear graph? Here bearish is downside. Look up, bearish is downside. This is bearish graph. Limited or unlimited? Limited. So we'll have this balance is limited. Now please look up once again. Graphs will take a curve from where? When you go back home now, open up any graph of your choice in registers you have, you'll be seeing this only. This strike price is 700. This strike price is 770. Look up the way of making a graphs. I'm saying once you'll finish off CA final, you'll not be doing any payoff profile. Look at the graph, make your strategy. Look at the graph, make your strategy. This at this point, how much loss you are in? Minus 33. Now, falling prices giving profit or upside prices? Falling. Logically should speak, how much should I fall from 770 so that I reach at 0? You are minus 33. 770, you have to cover 33 to reach at what? 0. How much should you fall? 33 you should cover up 737. So your graphical presentation. Graphical presentation. Done. Now next case is very interesting. If you are able to make it, that means you are 100% comfortable if this strategy comes. Once you've done till here, let me know. Done. Next is bear call spread. Now look up please. Bear call spread. Look up once. Bullish or a bearish? Bearish. Bearish means price falling down. That's fine. Minus plus you'll remember, that's only for the exam perspective. Till the time he does not ask logic, do not do what I'm saying now. If he does not say any logic, simply write minus plus and solve accordingly. Minus at lower strike price, plus at a higher strike price. Now since without logic it feels very uncomfortable, why are we doing it? Bearish, call. When is call bearish? Is call writer bearish or call holder bearish? That means I did C minus first. No matter what I write here, minus plus. Minus plus, plus minus is just a standard rule for you for the exam. But I should know from inside that I was bearish and call bearish is C minus. I did C minus. I'm not showing you the answer as of now. At lower strike price, higher, it's a minus plus now. At lower strike price, higher strike price, lower. What was lower strike price? 700. That means I would have eaten away the premium. When I do C minus, it's very uncomfortable, not for you, for anyone, when they're doing derivatives, not aggressively, practically. I'm not able to recall, sir, why C minus 700. Now let me do, someone else would have done what? C plus at 700. Why would someone do C plus at 700? He expect price to go above. That means I expect price to fall. What if the price starts increasing? Let's suppose idea. I write a call at 14 rupees C minus. I would be at loss when the price becomes what? Above 15, 16. You will not believe, in last 1 month back, it went up from 13 to 18. A 10 paisa premium of 18 went up to 1.5. The call writer will get what? A heavy loss. If I am a writer at 700, if the price becomes 750, gross loss or profit? Loss. The 800 loss, 850, 900. That means although I did C minus, and why I would have seen minus was, I was not expecting price to move above. But what if price starts moving? To hedge myself, I do C plus at 770. So what does it mean? It means if the price moves above 770, first option will give me what? Loss. Second option will give me what? Profit. It is called hedging. Understand the philosophy, please. For the exam perspective, again I am saying bullish plus minus, bearish minus plus, that's okay. But logic, if you have to create, just see which strategy or which option he was taking first. It was call bearish. Call is a C minus bearish. He did C minus at 700. Look up please. He did C minus at 700, assuming price will not go above 700. Since it was under a fear that if the price starts moving above, then he would be at what? Heavy loss. To safeguard himself from that heavy loss, he did what? C plus at this. And if the price now moves above what? 770, the first option will give him loss, second option will give him profit. Try to make and show me the chart please. Graphical presentation on your own. It's a bearish. It's a bearish. Chart, make the downside looking chart first. It's a case of initial inflow or outflow? Inflow. Make a downside chart, make a profit losses. What you do is, when you make, just do one thing, downside now, just make this kind of a chart. This is downside, bearish chart. We have a problem with the break even. Leave the break even. Leave the break even. Do you know the first 700? Do you know the second one? 170. No doubt. Do you know the profit? How much? 30. Do you know the loss? Minus 40. Now you are standing here at minus 40. How much should you fall so that you reach here? You are standing here minus 40. If you have to go 0 from 770, how much should you go here so that your this area gets covered? 40. How much break even? Logically think, at 770 I am loss of 40, and I know when I fall down, I'll be what? In profit. So how much should I fall down from 770? First I have to cover what? 40. How much? 730. Very good. Done? Now next I take is bull put. Next I'll take is bull put. When is, if from exam perspective you do what? Plus, minus. Leave it now. When is put bullish? Writer. Although I know from the exam perspective it should be plus minus, but put would be bullish when P minus. Put gives you, put is exercised when price falls. Holder expects price fall, writer price increase. So if by chance he writes a P minus at 770 and the price starts falling, think of situation. Why would he write P minus at 770? He will not expect price to fall below 770. But what if the price starts falling by chance? Then he would be at extreme loss. To cover himself, he safeguards himself at what? This. Understand what I'm saying? For example, when you write na bull put, bullish is plus minus only. But if logically someone says, why did he create this strategy? Put was P minus, assuming prices will not fall. But if the price starts falling, he will be at what? Extreme loss. So he covers himself what? P plus. I know some of my friends, for idea, for example, this last week what happened? They did was, they have written put. Price was around 17. They expected after the board meeting price will not fall. They have written P minus. Not to apply practically, please. It could be dangerous strategy. I'll just tell you. Last month, last Thursday was Thursday. Then it was Wednesday, Tuesday. 2 days back. Actually, what happens? Tuesday we were standing. The current month was to expire in 2 days. Premiums were very low. So what they did was 16 rupees put option. They bought the put option at 20 paisa plus, and they have actually, they did not apply the higher side. The 16 rupees put option of March series was available at 1.60 minus, or in fact 17. Let me put it at this way, 17. In fact March, this was Feb series. March series was available at 2 point somewhere 40 or something. Now when the price started falling, actually this was having a huge time value of money. So by the time it fell to 13.80 when it came, this price came down, I think approximately 2.2, and this price came down only to 3.50 because of timing difference. It's not exactly timing difference. In this case, it's end up making what? 2 rupees. In this case, they lost what? 90 paise. That was only possible last week. But what we are doing is same time period. People also create different time period, calendar months. Calendar wise difference also could be possible. So this was something which happened last week. I showed you, no? I think showed you that day, huh? It was there. Screenshot he sent me that is lost now. It was also there. That happened on Tuesday. There could be a possibility some people smartly do it. Current month, for example, now March is the beginning, so time value is huge. Actually, you should know, since you're writing the exam, time value of money is huge. Premiums are heavy. As the time lapses, premiums will fall. So within a 2 days, premium was very less, and for the month of March, premium was very heavy. So the writing at a next month, holding at a current month, event happened, price fell down. Basically, when the price falls, the timing will not fall so much. So timing will always erode the money. This went up very heavily and this came down. Something of this sort happened. This was actually a different calendar months. Similar strategy I am able to apply. Now when I am looking at this strategy, it gives me a strike that if you do only P minus, let's suppose he would have done P minus on 17 and no covering of the P plus, it would have been lost single day. Single day, your capital can wipe off. You cannot imagine, actually you cannot get the feel. I have seen the people who earn 50,000 premium, and if something bad happens single day, they might lose 90 lakh rupees. If you go back, just people search out how much loss a writer can make on a bad day. They'll get some examples which happens in the last couple of years. Writing is not so easy. It's not advisable to become a writer. Holder knows that my loss is limited, but holder also loses every time. It's actually the person who pays the money, he does not get anything, and the person who eats the money, he also does not get anything. I don't know who gets the money at the end of. So it's a very dangerous market, derivative market. But anyhow, since it's part of your course, everyone loves it and everyone enjoys it. It has to be done this way. There was a student in the previous batch who, if you know, before joining the class, said when you were earning, why did you leave? He said only 1 month was enough to wipe off 1.5 years of the call. But it's only not even 1 month, 15, 20 days, 1 day, one bad day, they can write off everything. Put writer is very dangerous, and actually he's safeguarding. Once you get that feel, automatically strategies will come out of you. Why it happens? And big players, they always hedge themselves. If they do not hedge, losses can be very, very, very heavy. Think it again. Writer is the most dangerous part, even most dangerous part. Because fall, you do not know till what level it will fall. The falling can be anything which can go. Writer, he writes first, although we write plus minus, he became writer expecting price will not fall. But if the price falls, he has hedged himself of the downside. Which any discussion done in the class is only for educational purpose, not to be attached with any personal dead alive. Only for educational purpose, since it's a part of the course. So derivative is fascinating. Earn money, it's very fascinating for very limited period. Anyone has Demat account? When you open, don't you see that SEBI guideline? 90% people lose money. That comes for you also. Comes for everyone. Comes for everyone. And actually, problem is the problem are some of the guidelines also. In last week, when the premiums are very small, the brokers will not allow you to buy those options. They will not allow. So a retailer cannot make a money. Retailer is retailer. It's easier. Find out the themes. I'm saying it very frankly since we're doing derivatives. Moving ahead, cash market will give you ample money if you live in India in the next 7 years. Identify the theme which government is focusing. The last budget, they were focusing on the solar, they were focusing on the tourism, they were focusing on the renewables, green energy. Think what they are thinking and you invest accordingly. 100% you will end up making money provided the same government comes. If different government comes back, look at their philosophy, understand what they are trying to do, the next changes what are coming. So accordingly you will be able to. Tourism is one big sector and green energy or renewables is another. Solar I think is something which they'll focus aggressively in the next. This is something you can do and there is ample money to be made. Because so much money is coming in the market, so ample money to be made, nothing to do with the derivative. It will give you sleepless nights. Actually everyone wants to become richer. It's not about you, me, everyone wants to become millionaire in a single day. We come to road. This is the one of the most dangerous strategies of traders. The idea is one of the difficult shares to earn money. One of the most difficult strips. No matter what you think, it will never happen. And when you do not think, something will happen in that. And someone was asking me, you were asking I think in the last class, that why on the good news price fall? Actually, it's not a good news. When the news has to come, the price is already inflated so much, it has captured that, and when news come, you think good news, but the price is already captured, that will fall. So that's market is buy on the rumor, sell on the news. So do not go wise unless and until you expect it to further go up. Otherwise, it's always the same case. And whenever, since you will become CA soon, you analyze the results also of the companies. It's not that if company is reporting a loss, the price will fall. If loss was expected 1000 crore and company reports a 500 crore of a loss, price will increase. If the company expected was a profit of 2000 crore and company earned only 1500 crores, price will fall. So there is expectation. The price appearing in the market is based on some expectation. If that expectation is met, nothing will happen. If that expectation is not met, then price will fall drastically. So it does not mean that if a profit, the price will not fall. Profit has come lower than you. Then some of the other different things has to be seen is EBITDA level is one of the very important term which we discussed in the M&A. EBITDA or EBITDA margin. That's a very important term. If your margins are increasing, that means the market will get lot of comfort. And then also you have to see what type of market we are in. Are we in the bullish trend or a bearish trend? Market also. The trend also plays an important. Friday it was a board meeting. Money is not coming. They've been doing board meeting for a long time. Every third, fourth year, second year they do the meeting, and in that expectation price increases, then price comes down. And now the public has become such disappointment. It's actually share aaya, nothing comes. When it will come, no one will have that share. This is actually Suzlon also same story happened. Nothing happened for n number of years. Now no one will be having that share. Lot of scripts I'm saying. If you are fundamentally know that company is good and you stay back for a longer period of time, and maybe generally when my for example when we discuss on the friends or stay back, at least one account should be such in which you buy fundamentally strong shares and not look at. Problem is the moment you look, you'll see profit coming 100%, 150, sell it off. You never know that 100 can become how much. You cannot even know that how much that profit becomes. The moment you'll see that apps which comes, the problem is of that apps every day see the charts etc. Not for a chartered accountant. You're strong at the numbers, you're strong at the balance sheet. Why do you need to look at the charts? This is not a general trading you have to do. Investment is different exercise altogether. When you're looking at the sector, you're confident of the management sector etc. Stay invested in that. But obvious that you have to look at them. A portfolio rebalancing I will do portfolio also. Portfolio rebalancing you can see 2 months, 3 months time. Unless and until you are equity advisor as per the SEBI. You have to look at that. Otherwise you will not be end up making a wealth. You can make money, you can make profit. Wealth creation will only happen when you have invested and stayed invested for a longer period of time. Provided actually today's market is not the same which was a 5-10 years back. You have to keep seeing your portfolio 6 months whether the theme which you bought or the company which you bought justifies or not. If you are not able to make sure that the company which you bought is staying the same kind of a confidence or the market share, or if it is not the winning position, you have to exit that company. You have to keep taking a call after 6 months time that whether my portfolio has to be reshuffled or not. But if you think I've invested in a fundamentally strong, for example, you found some company in the AI, found some company in the green energy, you found some company in solar, and you know it's okay, a fluctuation day to day it's okay. 6 months down the track, movement did not happen much, but you know this company is good enough. There could be a possibility 1 or 2 months in the 2-year time will come when this stock will double. Then stay invested. Unless and until you feel that this sector or a company does not justify the portfolio, then you have to exit. That is exactly how the investment has become nowadays. But anyhow, coming to this, how much is your graph showing? My break even comes at 730. Done. One independent question I am giving you full. Now you'll do it. I'll give you the prices also. You'll make exactly this way. You make me a chart and a payoff profile also. I'll give you a question independent. This I'm expecting has to be touched in exam sooner or later now. Seventh question, and I have given you draw a payoff profile also. This will help you in the options. Draw a payoff profile 80 to 40 interval of 5. The bear call. Seventh question. Mr. Bear writes a call with a strike price of 100 for a premium of 9. Also buys a call on the same underlying stock, the strike price of 110, premium of 5. Draw a future graph. Draw a graph for future spot prices of 80 to 140 with interval of 5. What I need is from you is the graphical presentation, maximum gain, maximum loss, and payoff profile. And if you think you can add break even point, add it, otherwise it's okay. The bearish call, I think, lower strike price. You have C minus at 100, C plus at 110. What you can do is instead of interval of 5, take interval of 10. Slightly reduce your work. That means 80, 90, 100, 110, 120, 130 and 140. That's it. Take interval of 10. 80, 90, 100, 80, 90, 100, 110, 120, 130 and 140. How much is maximum loss coming? Minus 6. Gain plus 4. Break even. Break even. 1 0. exactly what C minus at 100, inflow premium 9, C plus at 110, outflow 5, initial inflow what? 4 na? Maximum gain of 4, maximum loss of 6. To have maximum gain and loss, break even is coming 104. I'll show you the payoff profile now. C minus at 100, writer case it's loss, 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 loss. I have C plus at 100, status and gain which comes initial inflow. It was a case of initial inflow. Yes, case of initial inflow 4. Then you have net payoff. I have taken 104 for to include a break-even point. If you have not taken, fine. Can I move? Check your this answer, please. It was basically C minus at 100, inflow premium 9, C plus at 110, outflow premium 5, initial inflow, maximum gain, maximum loss, break-even point came, payoff profile. Fine. Coming back to working again. Was chart we I would have made some summary charts. I'll just show you. When you go back home in your graphs, you can remember. You can just read them out. Summary of graphs I've just made. It's a normal call option holder graph upside. First graph. Put holder would be P plus profit when price decreases. Downside. Downward falling is a put holder graph. Upside is a call holder standard graph. Put holder is a standard graph is price falling. This graph is C minus writer. Actually, if you look at the C plus is gaining, writer would be what? Losing. If you try to combine these graphs, actually, generally what you'll find in the books is, you'll find he'll make you, if let's suppose this is C plus, holder will make a profit, writer will be in profit when holder is in loss, and then this is actually this is the C writer graph C. So if holder is upside, writer is downside. Exactly same way this graphical presentation I have just made it so that when you go back home you are able to read it out. C minus, and when you refer, actually how do you read? Reading is the holder is in a profit when the price is downside, he will be in loss when price increases. Put will be opposite of put. Strangle will be this short and long. So long strangle will be basically a volatile in nature, C plus C minus. Short will be a C minus P plus. In similarly we have a long straddle, short straddle, strip strap, bull, what we have done just now, bullish, bearish. Butterfly also, when you go back home you can read butterfly would be 3 strike prices based, and then protective put. These are some common areas when you go back home. Till now what your institute has touched is call, put, straddle, strangle. I think rest I have not seen them touching anywhere. So in your classes when you would have done, you would have covered everything of that sort. These charts will help you out to know what strategy you are creating. When you go back home, you can just look at in your registers anywhere you would have studied. It does not make a difference. You'll have all the graphical presentation. This was just to tell you that graphical presentation is important to understand the break-evens, profit after what level, loss below what level, what comes out. Next is with you, I would have shared a sheet which the market. In this slide, if you look at how do we read markets now, the call option holder C plus is option holder price increase, C minus is a call option writer price decrease, P plus is a put option holder price decrease, put is a price increase, called option market. This is called option market. After that, I have futures will move in. There are in futures we don't have this kind of a structure. Future is only future buyer or future seller. F plus would be a future buyer, price increase. F minus would be a future seller, price decrease. This is a futures market. When I combined the option and future market, we get a derivatives. Cash market as of now has not come. Now will start coming in cash market. When I have S plus, so that's buyer in the cash market. You buy when you expect price to increase. S minus, we use a term for the seller, sell in the cash market when you expect price to decrease. It is cash market and comes a share market. That's exactly the structure. Especially we'll have a combination of futures and the cash market. Although we can create some strategy with the option and the cash market also. Now coming to futures now. Futures is a straightforward exercise in which there will be nothing called a option premium, etc. You don't have to do anything. It's simply if in the future market price of idea is trading at 14.40, there could be two parties, one could be you and second could be me, and we can only enter into a contract. What is the expectation? Let's suppose I expect price to increase and you expect price to decrease. Then we can do that. I'll become future buyer at 14.4 and you will become F minus at 14.4. If the price increases, let's suppose it becomes 15. Since I was a buyer, you give me 60 paisa. If the price decreases 14, I'll give you 40 paisa. That's it. There's nothing called exercise, lapse, etc. If there are only 2%, the future is a contract to buy or sell specified asset. In my case is idea. The specified asset, specified price 14.40, that is future price, and there is only one future price with respect to a single expiry. If it's a March month, we have a 14.40 at agreed upon date 28 March. The specified price is future price. Two parties are there, one is you and second is me. Obligation of both parties to perform. In the option market we have the one party had the right, second party had the obligation. Future buyer. Now this is, I'm talking about future buyer. This is a future buyer. The buyer of the future, it's not he'll buy in the future or he'll buy future. It's basically you've done the forward contract. What was the forward contract in the forex? Standing today, you're doing the agreement. Bank, I'll come to you after 6 months time. I'll buy the dollars. Bank, I'll come to you. I'll sell the dollar. Exactly same way. Today we start. Future price is known today only. How can we know future price? We know. That means actually the word comes derivative. It derives its value from the spot price. The idea is 14.4 because spot price is 14.25. If let's suppose the Indus Tower is spot price is 267, the future price would be 268, 269. So it derives its price from the underlying asset. Prices are nearby. It means if someone buys today, we call it a spot market. If someone buys agreement today, but buying selling will happen after a point of a time, we call future. Future word comes because it's exchange traded contracts. If it is over the counter, we call them as a forward contracts. Future buyer. Future buyer is a person. He will buyer of the futures contract. That means he has done the agreement to buy the share after a point of a time. Expectation price increase. Profit when price increases. Loss when price decreases. If the 14.5 I said I'll buy from your idea. If it becomes 15, I'll get 60 paisa profit. If it becomes 14, I have a 40 paisa loss. That's it. There is a second party called future seller. Seller of the future. Expectation is price decrease. If the price profit when price decreases. So if the price becomes 14, you are in profit. If the price increases, you are in loss. This has to be the simplest of all of them. The next slide I have taken is difference between the options and futures. This should give you clarity between both of them, that how the difference between them comes. Difference between options and futures. There are four parties in the options: call option holder, call option writer, put option holder, put writer. There are two parties, future buyer and seller. Obligation of the writer, holder has the right. Obligation of both parties to perform. Unlimited loss for the writer, limited profit for the writer, unlimited gain for the holder, limited loss for the holder. That's option market. In this case, both profit and loss are unlimited. That's it. Margin has to be now both parties have to deposit margin in case of future. Actually, we did not speak about the writer. Why it is difficult to become writer is because margin has to be deposited. For example, if let's suppose idea is 14.4 and lot size is 80,000, just on the calculator how much it comes. 14.4 into 80,000, 11 lakh. That's the contract value. If you do the future contract, there could be possibility he might ask you deposit 6 lakh as a deposit margin. Now, if you become a holder and you buy at a premium, you just have to pay premium. If you become a writer, there could be still possibility they'll ask you to deposit 5.5 lakh as a margin. So writer has to deposit a margin. Hence, it is not easy for a general retail person to become a writer, because what he does is holder, he knows I have to pay 20 paisa. 20 paisa into 80,000, 16,000 rupees, I become the holder. But if I have to deposit 5 lakh rupees as a writer, then 5 lakh rupees depositing is a huge amount that will be deposited, and as the fluctuation will happen, the money will keep deducted from you. So in the case of the options, writer has to deposit a margin. The option premium is paid by the holder because he can have maximum loss as a premium. No such premium exists. The rate at which contract is done is known as a strike price or excise price. In this, the contract is done is known as a future price. That's about the futures which comes out. Now, next party, from the exam level, you have these margin, although practically there are some other margins which are there. We are not even discussing because in question they only come, so I'm discussing them only. And this question which I'll be discussing now, as in the last three years, I think 3 times it would have come. I don't know what has suddenly happened to the institute. They are asking same type of a question. Maybe friends are making a mistake or something. Margins. Now, there are 3 types of margin. One is called initial margin, amount deposited by both the buyer and seller when they start playing. That is called initial margin. This is, I have written here 10 to 20% of the contract value. It is not 20. Depends on the volatility and it changes every day. In idea, for example, a movement comes, they ask you deposit 50%. And if sometime more movement comes, they'll ask you even deposit 90% of the margin. So it's better off to buy in the cash market. Actually, why people use the derivative market? It's a leverage position. For example, if the contract value is 10 lakh and I can buy the, idea I'll take this year. It was 14.4 into 80,000. How much is the contract value set? 11 lakh? 50,000 approximately, roughly I am taking. Now let's suppose you buy 80,000 shares in cash. You will have to make payment of 11 lakh 50,000. That's entire 11 lakh 50. If idea is non-volatile for some time and remains stagnant, then there could be possibility exchange will ask you pay only 20% in derivative market. It means in cash market I can buy only how many shares? 80,000, because I have to deposit full money. In the derivative market, I can leverage my position and buy up to 5 times. Because if I have to deposit only 20% in 11 lakh 50,000, I can do 5 contracts. But if it becomes volatile, they'll ask you to deposit maybe as high as 80% margin. If you deposit 80% margin, it's better off to deal in what? Cash market. So be careful when you're doing it. In second important problem with this is you have to buy in the lot size 80,000. In cash, I can buy 10 shares, 100 shares, 1000 shares, 500 shares, different prices. In this, it's a lot size. Which initial margin, I have just taken it, assuming a normal situation. Generally, for example, if anyone starts betting, you are a F minus, I am F plus, both of us will deposit 20% and start playing. Then comes maintenance margin. Then if 20% of this, let's suppose the exchange would have asked, how much is 20% amount? 2 lakh 30 30,000, 2 lakh 30. Now after that, the exchange will also put a condition. If this value goes below 75%, you have to bring in more money. That's called maintenance margin should not be hit. At any point of a time, you have to maintain in the account 213 to 75. How much? Sorry, 13 to 75. How much? 172. 500. If the balance goes below 172 500, you'll have to again bring in the additional money, and you have to bring in so much money such that your balance again becomes 2,30,000. That's called variation margin. Question has been asked in variation margin. Yes, suddenly they have picked up the pace. I don't know why. I'll show you that exam. First I'll do my question, then I'll show you the examination question. So maintenance margin is the margin you have to maintain. If that maintenance margin is hit, you have to bring in all variation margin so that it becomes initial margin. It is not that you have to maintain maintenance, it has to bring to the original level. That is called maintenance margin. Let me look at the question. Answer is such interesting part in this question. Answer you would know from the starting point only. Only thing format you have to make. Answer would be known who is gaining, who is losing. That's it. For example, we did the betting just now at idea 14.4. Price can become 14.6, 14.3, 14.8, 14.2, 14.1, 10, 12 days, 15 days it rolls, and at the end price freezes at 15. No matter what happens inside, my net answer I know would come difference of 14.4 and 15. So the exactly same thing will happen in exam. He'll give you n number of prices, the fluctuation will take place in those prices, but at the end you would know that what will happen. So answer when you're writing, no matter what you do inside, at the end just write difference of this and this is the profit or loss. For example, first question I'll cover up with you, basic question, then I'll give you some question. Let's look at this part here. Question number 1. It says January 15, when the spot price of the Infosys is 473 per share, X buys 15 contracts of July Infosys futures at 491. That means you are F plus at what? 491. Assume initial margin for Infosys 800 per contract. It's an absolute theoretical question. Maintenance margin of 600. And how many contracts is buying? 15. So one contract into 800 is the initial margin. 15 into 600 is the maintenance margin, and then these are the prices. I am not reading in between as of now. And is assume that Mr. X withdraws point from his margin account only once on January 16th. That means can he withdraw the amount? Anything above his initial margin he can withdraw. When he withdraws half the maximum amount allowed, compute the balance in the account at the end of each. Now no matter what I'll do in between, I started with what? At the end balance is what? No gain or loss would take place. No gain or loss would take place. It's 10% guarantee, no matter what he does in between. For example, you buy at 491, price becomes what? Profit or loss? Profit. In this case again, it's actually called mark to market. Daily settlement we call it as. Every day your account will be credited or debited. 491 to 496 profit would be credited to your bank. 496 to 503 again profit, then 503 to 488 loss, 488 to 485 profit, loss, 485 to 491 profit. So in the books you'll show profit loss, but at the end you know you started with what? 491 and balance is what? Price is 491, no profit, no loss would come. Answer you would know. In between you just have to show the process. I'm just showing you one way. I'm showing you another way. I'll show you from the book itself. If you are strong at your accountancy, then you can do the shortcut also. That I'll show you the institute. Some other way. I make 6-7 columns. He makes 3-4 columns, I think, and he does shortcut way. Let me show you the answer. Keep in front of you the. We have at this part here. He bought futures F plus at 491. Initial margin 12,000. Maintenance margin how much? 9,000. Lot size is 50 shares. Now I'll just show you the way of doing it. This will help you at some other place also. Portfolio. I think some security. That mutual funds we would have done exactly same. Rebalancing also can happen, but anyhow it depends upon you. Objective is you should know what profit loss will come. A margin account, this process we call it as daily settlement or mark to market. On January 15 we started. Opening balance we put it what? 12. My opening price was 491. Price became what? 496. So 5 rupees profit into 50 share into 15 lot. 5 rupees profit into 50 into 15. This profit. So my closing balance becomes 15,750. Next date becomes my starting. This price is my starting price. Price became what? 503. Since I was plus future buyer will benefit when the price goes up. So it will be 7 rupees into 50 into 15. This becomes your balance. Then he said on this 16 January he withdraws half the maximum allowed. So the initial margin was 12, maximum allowed will be 20 minus 12 into 15. He withdraws how much? 4,500. So balance remains what? 16,500. This is 16,500 becomes starting point. Then from 503 price becomes what? 488. Loss of 15 into 50 into 15 contract size, number of contracts. So the balance becomes 5250, which has fallen below what? Maintenance. So you have to bring in so much money, it becomes again the initial margin 6750. And then he starts with 12,000, 488, 485, again loss comes, but 9,000 was the maintenance, it has not hit, and then 9750 and price becomes this. His balance closing is this. Sir, how do we know he made the profit or loss? Not two ways of checking. He did not ask, but two ways of checking. He did F plus at what? 491. F minus at what? Again, if I assume 491 nil. Second way of checking is how much money he paid. How much money he paid was initially he paid 12, then he paid more 6750, and he has withdrawn what? 500. What should be the balance? 1450, and that is exactly the balance. So there is no profit loss. If by chance he says calculate the profit loss, either way you can show. I am saying what he started at 491, if he exits at 491, in between no matter what has happened, he gained, lost, gained, lost, gained, lost, nothing happened. He just passed the time. That was the time passing. 491 becomes nil, and in this case it happens 12,000 was paid, then second he paid was 6750, and he withdrew 4,500. His balance should be 14,250, and exactly balance is 14,250. That comes. Now second, I'll show you the question answer. Also I'll show you how to read that answer so that you are comfortable reading it out, which came recently in the exams now. So first part, yes, 64th. I've given you only one, although 2-3 times they've asked the question. Look at this part. The 64th. The price of March Nifty future contract on particular day was 9170. Minimum trading lot on the Nifty is 50 sheets. Nifty 50. 50 sheets we have. Initial margin is 8%. Maintenance margin is 6%. Index closed at these level. You are required to calculate mark to market cash flows and daily closing balance. Investor has taken long position as 9170. Now let us first do one thing. What the answer would come next, sir? He is asking net profit loss, na? Long position means he is long is plus, F plus 9170, and at the end it becomes what? 9140. Your plus price has fallen down. How much loss? 30 into 50. How much loss? How much 100? 1500 for a long. And second, someone who has taken a short position means it will be a gain. Let me see the second part answer first, then we'll do the internal. So he has shown this way only: ending margin, initial margin, what I said, all alternative, 1500 loss or 1500 profit. Or part is simpler. You did F plus at 9170, F minus at 9140. Sir, is it necessary? I've done. I'm assuming you would have exited. Even if you don't exit, you will know what is the balance. Into 50, 1500 loss, and for him he did F minus at this and F plus at 1500. This is or. I showed you both way. Now second part we'll do. Let's do this way. When you started at what? 9170. So 9170 into 50, what is the contract size? 4,58,500. This is your contract size. 8% initial margin into 8%. You started playing. That is, this is the money with which you start playing. 36 680, and 6% of it is not 6% of the initial now. He is saying 6%. If he would have said na the 75-80 percentage, that would have meant of initial margin. So 6% is 27,510. That means if the balance goes below this, you will have bring in the money. Now let us do roughly here. You started with this 9170 long position we are seeing. Next day price becomes what? 9380. 9380 minus 9170, 10 into 50, 10,500. So you started with this, you add up 10,500, I think balance becomes what? 47,180. If you are comfortable with this, it's okay. Next day price became what? 95,20. So you have what? 7,000 plus 7,000 more, 54,180. If you are comfortable, you can make this is institute what they have shown. Third day what happens? Fallen 9,100 from 95,920, 9,150, 21,000. Your maintenance is not hit, na? No, no. Maintenance is not hit. Maintenance is what? 27,510. Next day again loss. How much loss? 7,000. Actually, if you minus 7,000, your balance should have been what? 26,180. Is the maintenance hit now? Yes. And that he has not shown. Actually, problem is they show answer directly. So this is call money or a variation margin. Call money is because the call will come from the broker, sorry, of deposit. Actually, call will not come. You know, you would see someday, since you have done so much now chapter, there are few days in which market falls and they keep falling. It is not the market falls because someone is selling. Actually, what happens? A sudden fall comes and you have to deposit a margin, and it is very difficult for anyone to deposit instantly. And if you do not deposit, na, they'll cut off your contract. So they keep cutting, cut, and the market falls. That is called margin call. Margin call was not met. It does not even give you time. You cannot feel that out. When you enter in practical life, you'll realize someday if happen, Nifty was already 200 point down, and then 300, and then suddenly 200 more, 500, and the shares are down 10, 20%. Actually, they tried. No one has a time to call. They'll just give you only fractions of a second, maybe deposit the margin money, and no one has the time. Initially, you cannot deposit instantly. Even if you deposit, it takes some time. If you are not able to deposit, it will cut off your contract. For example, your balance became 26,180, and you would have received, in theory, get time, add margin, then solve. Practical life, this does not happen. The call came, by chance you said, I'm in meeting, they'll say cut, book loss, and then you will see price falls and then suddenly they jump up. This happened when, I tell you the perfect example if you have time, when Adani case happens last year. Go back and check. I cannot even tell you, means you cannot even realize the kind of losses the people would have learned. From 3,000 rupees, it started falling in a 2 days time or 3 days time, 1,000, and then same day from 1,000 to 15, 1,600. Both side, that means, and you know, public savers, oh, I wish I have bought at 1,000 rupees. When falling, something falling, no one has the courage. When it increases, then we make stories, oh, generally I tell them there is ample life, don't worry, this only one case has happened. Idea is there, etc. number of shares are there, try. No one has that courage. It's only if you are derivatives, especially those who do, if they do not maintain the balances in the account, their contracts will get squared off automatically, because broker will get a call from the exchange and broker will call you up. They keep extra margin, but if generally do not have, if broker is also over leveraged, then everything can go for it. That is margin. Margin is so dangerous. That's why shares will not get sold. You have shares, you paid the money, that will remain in your account. And this happened. Generally, this will happen with the margin. And I think you were talking to me that day when the fall came. The last week, some fall came. He was talking to me. That was a margin. I did not read. He was telling me it was a margin call which came. There could be a possibility margin call came. Margin is the most dangerous part you can have. I expect you to read these out. Chapter becomes interesting for you. You should know, because these are only numbers, plus minus plus minus plus minus. Anyone can do, unless and until you know what is happening. I was reading one of the reports in which a lot of positions are standing on the leverage, and when you stand on the leverage and you are not able to meet them out, square off your contract. Squaring off means automatically fall will come. So in this case, anyhow, in this case we are assuming the broker was nice, client was also good, within a fraction of second he paid, his balance again becomes, and at the end the balance. In short position, the margin was hit on the second day itself in the short, because price went up, the margin was hit accordingly. I hope you can try out. This question has come 2-3 times in last couple of years. Maybe because the paper setter would have learned there's something called futures markets. So this is only has come. If by chance a paper setter knows about the bull spread, bear spread, and set the paper, which is, I don't know how comfortable he would be. If he is actually, how does a paper setter sets a paper? The more comfort he comes. One way is pick up exact questions from different resources and then put it. One is you are in the practical side of it and you look every day and then you create the question accordingly. You can. So this is the first type of variety of the question which comes in the I'll just quickly discuss with you the way of calculation of future price, so that tomorrow when we come we can do some extreme mathematics on the futures. This was one variety of a question which comes in the exam. Then how do we calculate TFP? When we started future price, when we started our class, I discussed with you that cash market price of idea was 14.25, the future market was 14.4. This is very important. Now what I am discussing, and in currency derivatives we have some questions coming in which will show a difference between a cash market and a future market. That will help you out at that point of a time. Now how do that pricing happens is, that pricing happens, we have on 13th slide, I am there. I have used word theoretical future price. You can assume that's a future price calculation. Why I have used theoretical future prices? Because if as per me the prices are not same which are appearing in the practical side, then I can create an arbitrage, which we'll do tomorrow, but today we'll make a setup for that. The calculation of theoretical future price, we use cost of carry model. As per that model, there has to be some relationship between spot price and future price, so that there does not arise any arbitrage opportunity or a profit possibility. It means because of the difference that cash market and future price, actually cash and future market, remember one thing, if this is 0 period, cash price, spot price is also standing here, future price is also standing here. Difference is, if you do something on cash, settlement happens instantly. If you do something on future, you enter into an agreement today, settlement will happen at a certain point of a time. So between these two there should be some symmetry, or there should be some logical understanding. If that understanding goes, then there would arise arbitrage possibility. And how do we decide, sir? TFP price is nothing but spot price. For example, idea spot price was 14.25. Cost of carry is based on the interest rate, and there is no dividend comes here. That case there was no dividend, so I have written actually dividend is minus. So the basic purpose of this is, if let me take a simple example, 0 period I am standing, let's suppose 100 rupees is spot price, interest rate in the market is 10%. If I want to buy this share today with not my money, I borrow from somewhere else. If I borrow 100 rupees, this 100 rupees, assuming I'll keep this share for 1 year, this, if I keep this share for 1 year, the value of this share after 1 year should become 110, because if I borrow 100, my costing would be 10%. Without any arbitrage opportunity, I should be able to make out no profit, no loss, provided it is sold for 110. It means the future price of this 100 rupees, provided the interest rate in the market is 10, should be 110. It means if you buy the share today, or if you buy the future today, that settlement happening here, I buy the share today and do the agreement in the future market to sell, I would be at no profit, no loss. I would be able to settle down provided rate is 10%. Assuming dividend income from this share, history tells is 4 rupees. If 4 rupees dividend come, that means even if my share gets sold for 106, I would be at no profit, no loss. So my future price should be at 106. So that is how exactly formula comes. 100 plus cost of carry 10% of this 100 minus the dividend. This comes out future price. Now what happens? I have taken the same example here only. Example, calculate 12-month future price. Following data available: spot price 100, interest rate 10, dividend in 4. Spot price plus cost of carry minus dividend, it becomes what? 106. That means if the actual future price is 106, there is no arbitrage opportunity. We say if actual future price is 106, there is no arbitrage. If actual future price is not same as this theoretical future price, there would arise arbitrage opportunity. There would arise arbitrage opportunity or arbitrage profit, which I'll see in the next session because that's an important part of the calculation. These terms, second, third, fourth, were not so important maybe before the MCQs came. Now I think they can ask you the wordings. TFP greater than spot price. Generally future price would be greater than spot price. We call that a Seedha Badla. That's a Hindi term. It's a very general term brokers use. English call it as Contango. In English is Contango. That means future price is more than the spot price. In idea 14.4 was higher than 14. Reverse can happen when dividend income is more. When TFP is less than spot price, means future price is trading at a discount to the spot price. We call Ulta Badla. It's a common term used, and English it is called backwardation. Difference between spot and future price is known as a basis. Difference between spot minus future is known as a basis. So MCQ can come. Basis would be negative in the Seedha Badla Contango because spot minus future. Spot is lower than the future, so basis would be negative and basis would be positive in the second one. From the MCQ perspective, you can keep on radar. Contango is an English term. If you go and tell the broker Contango, he'll ask you which tango you are talking about. I don't know. But if you tell him Seedha Badla, whether it's English, Hindi, any language speaking, they understand this one. Seedha Badla is future should be costlier than today. That's it. Seedha Badla. Forward rate when you calculate in the dollars, that's Seedha Badla is actually future rate is more than the forward rate is more than the spot rate. Exactly same thing we're talking about. Reverse can happen when there is a dividend. Generally it can happen when the dividend is very high amount. In the PSU companies we see this kind of a trend generally. But in practical life there is certain difference. In practical is not so straightforward. Just for a knowledge purpose, in exam you'll do the same way what we are doing here. Practical life, the dividend is adjusted up to certain percentage and after that it is not adjusted. There is difference in the practical life. I'll not discuss it out here because my theory will go for a toss. So earlier it was, that means if you look at here, it means if dividend income comes, you always subtract from here. Yes. Practical life, maybe no at certain point of time. Not discussing that now. We're discussing just only TFP greater than this Seedha Badla or Ulta Badla is there. How does it matter, sir? Actually by looking at, for example, this March results will come. In April new series will start. By looking at the difference of the future price and spot price, there are so many experts. They can tell you whether dividend will come or not, or what amount of dividend is expected, because they have been tracking this market for so many years. By looking at the differences of these prices, Seedha Badla and Ulta Badla, actually one more thing I should tell you, any discussion I am doing it only for educational purpose. Track it once. I am not saying they are very dangerous. It's only I keep track for my educational purpose. So today something happened. I'll show you. One of the share I keep telecom sector on radar, telecommunication basically. They're called Tata Communication. Just to you, the practical life is very different from the theory world. Look at the cash market price. It's 1985. Don't think about the increase decrease. I'll go to derivative now. Derivatives and current. Closing was approximately 1999. Let me click here. Complete. Click here. Complete. Look at this. The closing price is 1995. This is talking about. Don't look at the weighted average price. Underlying value 1985. Can you see here? Underlying value. You know what is the meaning of underlying value? Cash market. Cash market price is 1985. It's 1999.95. No advice of buying, selling, etc. Anything. If you want, keep a track. Those who are watching live, just keep a track for your reference purpose. This difference is how much? 14 or 15. Actually, the larger the difference between the cash market and future price comes, it means trend is bullish. It means trend is bullish generally. In idea, you can come to know, if you want to track for reference purpose, whenever the gap between the future and the spot decreases, it means there is no craze of someone buying in the future. This in the morning went up very high also, I think. I just keep a track of it. And I do not know if something is happening in this counter or not. This generally remains 7, 8 or maybe 10 rupees gap. But this today is showing what? 15. Either it was a short covering. Short covering is someone who has sold and they are covering their position of the fear price will increase. So that's why the price increases. Or second could be, it could be a bullish trend. So it is not necessary that the gap would be, this is called Sida Badla actually. The difference is that some shares you will find when the dividend is about to come, the gap becomes smaller and the gap can become opposite. That is why it comes Ulta Badla, that comes. So practical side, when you move, if you are actually tracking some share, if you are actually in the equity markets, you will find that higher the gap between the spot and the future price, it can reflect. Fundamentally, you will see, fundamentally, sir, it is not justifying. But theoretically, fundamentally, it is not justifying, but actual market price is huge gap. It means there are some buyers who are buying in futures aggressively, or it is only possible when there is some expectation build up. In idea, generally you will find the gap if between spot and future increases huge. There could be a, but because idea is such a small, a 5-10 paisa gap, we don't even come to know. In this, at least we are able to come to know 15 rupees. So you'll track it if you want for education purpose. Track for next few days. If the gap comes 4, 5, then you will not find much of movement. And if this gap remains 15 rupees for 3, 4 days or 2 days, then you will find something will happen. The price can shoot up. Or the short covering. This can happen because of few reasons. A short covering or maybe aggressive buying. Short covering is someone who sold. They are covering their position, because someone who sold, they want to cover up. If they do not cover up, there could be extreme losses. This is how the futures market are traded. Option market also we can find out these kind of trend, but option market is so vast, it's difficult to find out by looking at premium, whether what kind of premium is bullish and bearish. So this was simple enough. Since it required Sida Badla, Ulta Badla, we are able to. I'll try to find out if some stock I am able to say which has a Ulta Badla. I'll confirm from someone and I'll show you if it's something is there in the market. But generally in March month we have very rare. In April we can have, because some companies will announce the result and there could be expectation of dividends. Wind up here. I'll see you tomorrow. Continue from here. Take care. Bye. Last thing again, any discussion I'm doing today or tomorrow next class is only for educational purpose. Bye bye.